The modern financial market operates as a highly calibrated mechanism designed to prey on participants who rely on isolated, simplistic data. Take a look at this chart tracking the S&P 500. We see the price steadily descending toward a widely recognized historical support level. The moment the price drops below that threshold, technical systems read it as a definitive breakdown. Sell orders flood in, stop losses trigger. Then the trap springs. Instead of continuing downward, the price abruptly hooks and rockets back up. This liquidity extraction event, often called a Wyckoff spring, immediately destroys those newly minted short positions. Viewing a single asset's chart in a vacuum is a massive liability. It often tricks retail traders into providing the exact liquidity smarter participants need, right when the market is poised to reverse. We tend to look at narrow trading ranges and sudden breakdowns as clear, actionable signals that a trend is resolving. But these tight periods of compression often represent something else entirely. Sometimes they show a market in a state of efficient balance. Other times, they reveal a buildup of systemic fragility, a volatility paradox, where tension accumulates until it releases to inflict maximum pain. To find the signal in this noise, we have to examine the relationship between the S&P 500 and the assets it historically tracks. This graph maps the S&P 500 and the NASDAQ. As structurally co-integrated assets, they move in tandem. Rewinding to that exact false breakout, the S&P 500 dips to a lower low, but at that identical timestamp, the NASDAQ formed a higher low. The indices diverged. This momentary break in their statistical relationship is known as SMT divergence, or a smart money tool divergence. That failure to confirm the breakdown is not an algorithmic glitch. It is a structural anomaly exposing hidden institutional intervention occurring in real time. Nearly a century ago, analyst Richard Wyckoff observed that major market movements are rarely accidental. They are often orchestrated by a collective, strategic force. Wyckoff called this force the composite operator. It serves as a metaphorical framework to understand the coordinated, data-driven actions of massive mutual funds, banks, and institutional investors. These entities face a unique logistical problem. When they need to accumulate massive positions during a market panic, they cannot buy all their shares at once, or they would drive the price up prematurely and ruin their own entry. Their solution is to quietly absorb the selling pressure in the relatively stronger asset, the NASDAQ, effectively creating a hidden floor. Meanwhile, they allow the weaker asset, the S&P 500, to fall through its support to trigger retail stop losses they can buy into. SMT divergence is the data exhaust of this process. Institutions are effectively restricted by their own immense size, leaving this structural footprint behind when they accumulate. We can see the immediate aftermath of this dynamic right here on the chart. The weaker asset snaps back upward, closing the divergence gap to rejoin the stronger asset's trajectory. The trader staring at an isolated chart was stopped out by the trap, but the trader measuring the divergence had evidence of a reversal well before the price ever confirmed it. This behavior extends beyond U.S. equities. It is a universal momentum structure. You can identify this same pattern of early exhaustion and continuation occurring across cryptocurrency markets, foreign exchange pairs, and global index futures. Strategies rooted in market structure tend to be more resilient than those based on curve-fitted parameters, as they rely on the underlying mechanics of how large orders are processed. To read these markets accurately, you have to look past the single chart and hunt for structural strength in the form of non-confirmation within correlated pairs. Identifying where the price fails to follow its counterparts provides a clearer picture of institutional intent than simply reacting to a breakout.